All right, let's get into it. We're going to look at what I'm calling the Sharia accounting blueprint. It's all about how you build a financial statement, but with a completely different set of rules. It gives you a whole new picture of a business. You've seen a balance sheet, right? Of course you have. Assets, liabilities, equity, we all know the drill. But what happens when you slap the label Sharia compliant on it? Suddenly, everything changes. And I'm not just talking about rearranging the numbers. We're talking about a whole new philosophy. So, what is that change? Well, that's exactly what we're going to unpack today. Here's how we're going to break it down. We'll start with the rulebook itself. Then we'll get into the big ideas, the why behind it all. We'll look at the unique pieces of the puzzle, see it in action with an actual statement, and then finish up with the big idea you should walk away with. Sound good? Let's do it. Okay, first things first, the rulebook. Now, it's super important to get this. Sharia accounting isn't some vague, made-up thing. Nope, it has a formal, official, conceptual framework. You can think of it just like IFRS or GAAP. It's the set of official guidelines for how you put everything together. And this framework, it's really the foundation for the entire structure. It's what guarantees that everything is consistent, transparent, and actually follows Sharia principles. I mean, without a rulebook, how could you ever build a statement you could trust? You just couldn't. So who actually uses this rulebook? Well, basically everyone. You've got the preparers, the accountants actually putting the statements together. You've got the auditors who have to sign off on them. And then you have the users, the investors and anyone else trying to make sense of the numbers. It gives them all a common language to speak. Okay, so we've got a rulebook, but what's the spirit behind those rules? This is where it gets really interesting. This is the why. See, conventional accounting is all about things like the accrual basis, right? But Sharia accounting, it starts from a totally different place. It's built on a foundation of ethical and social principles that shape every single transaction. And here they are, the 5 big foundations. We're talking about things like Ukhuwah, or Brotherhood, which is about community over just cutthroat competition, or Adalah, justice, making sure contracts are fair. It's about creating real benefit, Maslahah, for everyone, not just the people at the top. This ethical layer, it isn't an afterthought. It's the very heart of the system. Now, let's talk about a really key concept, Gharar. Basically, this means avoiding excessive uncertainty. No ambiguity, no wild speculation. In Sharia finance, contracts have to be crystal clear. You can't, for example, sell something you don't actually have yet. The whole point is to get rid of the guesswork and make sure no one gets taken advantage of. And this next one, this is a big one. Al-ghulmu bil-ghurmi. It's a fancy way of saying no gain without risk. It is the absolute bedrock of Islamic finance. You can't make money unless you're willing to lose money. There has to be skin in the game. And that's exactly why traditional interest is a no-go. Interest is a guaranteed return, right? There's no real risk tied to the business's success or failure. Under this principle, profit has to come from actually participating in the venture, from partnership. All right, so that's the big picture philosophy. But how does all that ethical stuff actually show up on a financial statement? How does it translate from theory into actual line items you can point to? Let's take a look. Okay, check this out. On the left, you've got the accounting equation we all learned in school. Assets equals liabilities plus equity. Simple. But look at the right. In the Sharia version, we've got assets, liabilities, and then this new thing wedged right in the middle, dana shirka temporaire. So what in the world is that? This is the game changer right here. Dina shirka temporaire. It translates to temporary partnership funds. Now think about this. It's money from investors, but it's not a loan, so it's not a liability. And it's not ownership, so it's not equity either. It's something else. It's an investment from a partner who has agreed to share in the good times, the profits, and the bad times, the losses. This one little category completely changes the financial DNA of the company. Theory is great, but let's see what this actually looks like on a real statement. We've got a simplified example from a Sharia bank here, and you can see how all these pieces come together. So take a look. On the left, you've got your assets. Cash, receivables, looks pretty normal, right? But now, cast your eyes to the right side. You've got your standard liabilities up top, you've got equity way down at the bottom, but then boom, right there in the middle, in its own special section, is our new friend, Dana Shirka Temporaire. And that's where you see things like Mudaraba deposits listed. And this is it. This is the proof in the pudding. Those funds aren't just a regular liability. The bank doesn't owe a fixed amount back. Nope. The bank is basically using that money as a manager. and the people who put the money in are partners. Their return, their profit, it all depends on how well the bank does with its investments. It's a true partnership, literally written onto the financial statement. Okay, so let's zoom out for a second. We've seen the rules, we've talked about the big ideas, and we've seen it in practice. What's the big takeaway here? What's the fundamental mind shift that Sharia accounting brings to the table?
I think this quote says it perfectly. Sharia accounting isn't just about shuffling numbers around for the sake of it. It's about showing a totally different kind of relationship with money. It's a move away from the classic lender versus borrower setup and a move towards a model of partnership where everyone, investors, entrepreneurs, is in it together, sharing both the risks and the rewards.
And that leaves me with one last question for you to think about. Just imagine for a second, what if every company's financial statement had a section called partnership funds sitting right next to liabilities? How might that change how we all think about business, about risk, and about what a company is even for? It's a big question, and it really gets to the core of what this whole blueprint is trying to do.